Welcome to Money RX for CRNAs. I'm your host, Brett Fellows. I'm a certified financial planner who specializes in helping W-2 and 1099 CRNAs lower taxes, invest smarter, and retire on their terms. I recently had the opportunity to speak with a group of 1099 CRNAs through the 1099 Success Academy about why traditional pre-tax retirement savings could be a financial disaster for many CRNAs. And I got great feedback, so I thought it would be important to share the same message with all of you listening or watching. The Secure Act eliminated the stretch IRA. QBI deduction interactions reduce pre-tax benefits. And we're at historically low tax rates. The math has changed dramatically. What worked for your parents might actually hurt your retirement. So in today's episode, we'll cover why traditional pre-tax contributions are essentially an IRS loan that you'll pay back at unknown future tax rates. The $37 trillion wealth transfer coming from baby boomers, and why Roth accounts provide the control and certainty that you need in retirement. Let's jump in. So I want to start today by giving you a quick overview of what a solo 401k plan is, and I want to do this for two reasons. First, I believe this is the best retirement account that 1099 CRNAs should own. Anyone who is self-employed and has no employees other than themselves, with the exception of the business owner's spouse as the only other employee, can open and contribute to a solo 401k plan. Now, it doesn't matter if you're a sole proprietor or an S-corp. Anyone can use them. Conceptually, a solo 401k plan works the same as a 401k or 403b plan for a larger company. The employer and employee are both allowed to make contributions on the employee's behalf. But because a self-employed person is both the employer and employee in a solo 401k plan, there is effectively one annual contribution with two different layers, one each for the employee and employer portion. And depending upon your age, you may be able to save up to $77,000 into a solo 401k plan in 2025. But secondly, and more importantly, a solo 401k plan allows you to make Roth or after-tax contributions. And these Roth contributions are allowed on both the employee and employer sides, which is new since 2022. So all funds will receive tax-free growth and distributions. All funds will not be subject to required minimum distributions, which we'll talk more about later. Because not having required minimum distributions is where the magic happens. So it's the tax treatment of the contributions that I want to talk about today. And in that regard, let's kick off this episode with a bold statement. Traditional pre-tax retirement accounts are probably the worst to own and build on. Now, traditional pre-tax before 2020 were a great thing. You could defer taxes for your lifetime, and then you could defer taxes over your beneficiary's lifetime. And this could easily last 50 to 60 years, and it's known as the stretch IRA. But then Congress came up with the Secure Act, and this was an earth-shattering event in the financial planning world because they stopped our ability to defer tax, making today traditional pre-tax retirement accounts the worst possible asset for wealth transfer and estate planning. What the Secure Act did, it eliminated the stretch IRA provision for non-spouse beneficiaries by shortening the deferral period to 10 years after death. So everything you've accumulated, tax deferred, remember, will now have to be pushed out into this shorter window, and all taxes paid by the 10th year after death. So even if you thought you were in a low tax bracket, you will be pushed into higher brackets. And because it's the future, we don't even know what the tax rates will be at that point. So this Secure Act was a big money grab by Congress, and this has changed everything. Now, the first and biggest argument I'll get from CRNAs by making this statement is that with a traditional pre-tax retirement contribution, you get a tax deduction. Let's say you make $50,000 and you put $10,000 into a traditional pre-tax retirement account. You're only taxed on the $40,000 today. Now, the $10,000 you may say is the deduction, but is it? To me, it's not a real deduction. Here's how I think about deductions. Some are real. You get to keep them. When you give to charity, you keep that deduction. Nobody comes back for it. When you deduct mortgage interest, you keep it. No one's asking you to return it. Same with medical expenses or the standard deduction. Once it's yours, it's yours. But then there are these so-called pre-tax deductions that people brag about. That's not the same thing because yes, you get the upfront break, but eventually Uncle Sam makes sure that you give it back. So I call those fake deductions. They feel good today, but they're not really yours to keep. To me, a real deduction is something you get to keep. This pre-tax deduction, people like to say, is a fake deduction because we have to give it back. It is really just a loan you're taking from the IRS to be paid back at the worst possible time when you need it the most, retirement. And to make matters worse, it's at an unknown future tax rate. So a traditional pre-tax contribution is not a deduction. It's an IRS loan. And there's nothing worse in retirement than looking ahead to uncertainty of tax rules. You want to know what it's going to cost, what you can live on. You can't have that in the government's hands. Why would you hand over your financial plan to be dictated by the government? So my goal today is to get you to think long term. When I talk to CRNA clients, I really try to focus the conversation around lifetime taxes. When I talk about taxes, everybody immediately thinks about what I'm going to owe or what I'm going to get as a refund this year. That's short-term thinking. In everything we do with CRNA clients, it's lifetime tax planning because it gets our CRNA clients to realize that this is a game of chess. You have to play 3 to 4 moves ahead. The goal is not just about what you owe or what your refund this year is. So that's the first argument I'll get, the so-called fake deduction. Now, the next thing I get challenged on is, well, what about the company/employer match or contribution? As I mentioned earlier, beginning in 2022, the match or employer contribution on a solo 401k plan can also go to Roth. I'm not saying don't contribute to a retirement account. Of course you want to. What I'm saying is you want to go to Roth. That's where you should be going, building tax-free. Another reason you don't want this fake deduction, besides the reason that you have to give it back, is that good tax planning dictates Take deductions when rates are high, and take income when rates are low. Tax rates are the lowest you may ever see in your lifetime right now. So this is when you want to take income and pay taxes. Traditional pre-tax deductions are worthless to you right now. Not only because rates are low, but again, because you have to give it back. Tax rates are low from a historical perspective, and there are big budget pressures facing the federal government in the years ahead. This means the traditional pre-tax retirement account is in a precarious position, as the funds in such accounts are not avoiding taxes. They are merely delaying them. But many people don't realize how high taxes were and just how low taxes are right now. U.S. income tax began in 1913 at a starting rate of just 7%. And at the time, opponents argued for a provision to cap the tax rate at 10%. But tax proponents poo-pooed such a cap as unnecessary. They couldn't imagine rates would ever exceed 10%. Well, just 5 years later, when the government sought funds to fight World War I, the top rate spiked to 70%. Flash forward another 3 decades and the rate topped 90% following World War II. Not until 1982 did the top tax rate finally drop from 70% plus down to 50%. Finally, taxpayers were equal partners with the government on our own money, and we thought that was fantastic. Today, of course, the rates are much lower. Today's top tax rate reaches just 37%, although many people pay rates as low as 22%, 12%, or even 10%. In other words, these are bargain basement prices. But these rates can't remain this low. It's simple math. Congress needs money. Congress so far is kicking the can down the road. But at some point, it's going to hit the fan. Tax revenue is just too low. And they're going to have to raise tax rates at some point. And the people that are going to get caught in the mud are the ones with the most money in traditional pre-tax retirement accounts, because they're easy pickings and low-hanging fruit for Congress at that point. So, with a pre-tax deduction, all you are doing is throwing gasoline on the fire. If you're going to do that, do it to a Roth. Now, I get it. I know it's hard to hear not getting a deduction right now because you want the tax benefit. But remember, you have to give it back at the worst possible time. There's what's known in accounting as timing difference, like depreciation. You get a deduction now with a pre-tax contribution, but you give it back eventually. So this is all about timing. And in retirement, you want certainty. Right now, you can lock in these rates, and that's where you want to put your income. This business of deductions is fool's errand, in my opinion. It's short-term thinking, and it's all I hear through April of every year. Let's switch gears for a minute and talk about Section 199A, the Qualified Business Income Deduction, also known as QBI. Now, in its simplest form, you get to deduct 20% of eligible business income. And this is available to all CRNAs on a 1099 self-employed basis. Now, it is phased out if you make more than $192,000 if single or $384,000 if married filing jointly. But this does add another layer of tax savings if you're in the income range. Let's take a look at example 1. You have qualified business income of $140,000. You have income of $120,000. The 20% 199A deduction would be applied to the $120,000 of taxable income, the lesser of the two amounts, producing a deduction equal to $120,000 times 20%, or $24,000. Now let's look at example 2. You have qualified business income of $150,000. Your taxable income is $170,000, including your spouse's wages. Here, the 20% 199A deduction would be applied to the $150,000 of combined qualified business income, again, the lesser of the two amounts, and would be equal to $150,000 times 20%, or $30,000. So these are great deductions. Now, if you've already begun thinking ahead, you might be wondering, can't I make a pre-tax retirement contribution that would lower my income, thus increasing my QBI deduction? This is a win-win situation, right? Well, your thinking would be spot on. However, the IRS thought about that too. And so they were kind enough to create a retirement contribution deduction problem for you. Let's look at the QBI problem through Robin CRNA. Without a pre-tax contribution, her QBI is $90,000. Her taxable income is $170,000. Her QBI deduction is $90,000 times 20%, which equals $18,000. Instead, if she went ahead and made a $20,000 pre-tax contribution, her QBI goes to $70,000, which is reduced. Her taxable income is $150,000, again reduced. So her QBI deduction is $70,000 times 20%, which is $14,000. Her total deductions is $34,000. The $14,000 QBI deduction and the $20,000 pre-tax retirement contribution. So with a $20,000 pre-tax contribution, Robin's net increase is only $16,000, not $20,000. So I want your takeaway from today to be this. For every $1 in pre-tax retirement contribution, you get 20 cents less in QBI deduction. It's that simple. Although pre-tax contributions are good because they lower your adjusted gross income, they also shrink your QBI to a smaller 20% deduction. So although Robin contributed $20,000 to a pre-tax retirement account, she only got a $16,000 real reduction benefit. This is almost like her making a $4,000 Roth contribution and a $16,000 pre-tax contribution, but she never actually gets credit for the Roth portion. It just disappears into the ether. Let's talk about another argument against my statement today. I've had CRNA clients come to me and say, wait a minute, Brett. You said that this is a bet on future rates and always pay taxes on the lowest rates. Well, I'm going to be at a lower tax rate in retirement. I mean, I'm making $300,000, $400,000 per year now. When that's done, I'm going to be at a lower rate. So if you say pay taxes when rates are lower, I'd rather pay them in retirement. But that client is forgetting one thing. Doing nothing is not an option. Because if you do nothing, your pre-tax retirement account continues to grow. And at some point, if you do nothing, you ignore the problem by putting your head in the sand, there is a point where you're going to be forced into what I call the government plan. You want your plan, trust me, not the government plan. What's the government plan? The government plan is at age 73, the dreaded RMDs are required. and the R is for required, minimum distribution. And in most cases that I see, so much account value has been built up over the years. CRNAs easily have $1 million plus in pre-tax retirement accounts. You may owe more in taxes during retirement than when you were working. And if you've been saving for 20 to 30 years, I'm telling you, your account values are too large to avoid. Doing nothing is not an option. It's not about what you're making now. It's about what you're keeping later. Let's now also talk about a tax time bomb that is completely out of your control, also caused by the Secure Act. There is currently over $37 trillion with a T sitting in pre-tax retirement accounts from the baby boomer generation, your parents and grandparents. This wealth transfer is going to happen in the very near future. Now, you want to inherit tax-free money, but to do that, somebody has to set that up for you. For example, I get questions from beneficiaries all the time. If I inherit my parents' pre-tax retirement account, can I convert that to a Roth? No, your parents have to do it. An inherited pre-tax retirement account cannot be converted to a Roth. That's something your parents or whoever is leaving you the money has to do for you. I also get questions from 75-year-olds asking, should I convert to Roth and pay the tax at my age? And the answer is, well, it depends on who you're doing it for. If you're doing it for yourself, probably not, because given your life expectancy, sorry to say, the cost may not be worth the benefit. But if it is for your children or grandchildren, then this is like a gift. You're doing it for them. But if you do convert to Roth, you've guaranteed, first of all, for yourself, you've guaranteed by converting to Roth total control of your money, income tax free, for the rest of your life. But also for your beneficiaries, they can keep it tax free for 10 years after your death. They can keep it growing, building, accumulating for the full 10 years after your death. Then they can pull it all out income tax free. So this will work great for CRNA beneficiaries who are already higher earners today. And the last thing you need is to get walloped in year 10 by inheriting a traditional pre-tax IRA, throwing you into the highest of tax brackets. And guess which country has the most centenarians? That's right, the United States is in first place by a mile. So not only are we living longer, needing our money to last longer, there's also a ton of money that's going to be transferred from generation to generation. And if you're living to age 100, can you imagine how things may change with tax law from now until then? No way. So this is why we want guarantees when it comes to our money. As opposed to taking a chance in retirement when every dollar is critical on what rights may be, do you want to go into retirement with a might-be approach? It's not good. So for those of you I've now thoroughly scared and you have all this pre-tax money built up and you're seeing, hey, I have this building tax problem. How do I deal with that? So I'm a big Roth fan, if you can't tell, obviously, for pretty much any CRNA because the rates are so low and account balances, thanks to the stock market, even with the volatility we've had earlier this year, most account balances are being built up. Roth is the greatest account to have because everything in there grows income tax free for the rest of your life and then 10 years after for your beneficiaries. I mean, imagine getting a statement in the mail and saying, "This is my Roth account balance and it's all mine. I don't have to share it with Uncle Sam." So it's a great account. The only question is how much are you willing to pay for it? That's the catch. So other than saving future retirement money into Roth, for those of you who already have traditional pre-tax retirement accounts, one other option to consider is a Roth conversion. Well, what is a Roth conversion? To me, it's a big giant bet on the future of tax rates. If they're higher in the future, and I believe that they will be because of our national debt, then that's a pretty good bet. The reason I like this bet is because even if I'm wrong, and I'm wrong about everything I've said to you today, Congress lowered rates somehow. What is the worst case scenario if you paid taxes now and converted to Roth? This is the worst case scenario. You've locked in a 0% tax rate for the rest of your life and 10 years beyond for your beneficiaries by locking in today's low rates. That's not a bad consolation prize, even in a worst case scenario, because you can't beat a 0% rate. So always pay taxes at the lowest rates. If you can always get your money out of your tax-deferred accounts at the lowest rates, you'll always have more. And that's what Roth conversions are, moving money from tax-deferred and paying tax. If you can get the money out at low rates and get it into Roth, you'll be a winner in almost every case. But you have to use the tax brackets. And the brackets are great now. We have the lowest rates in history. And we have giant brackets, 12%, 22%, 24%. Hundreds of thousands of dollars can pass through those brackets and still be unbelievably low historical rates. But these bracket opportunities won't last forever. Now, in the spirit of showing you a real-world example of how Roth conversions can work for you, I have a case study to walk you through. Let's look at Reggie and Regina CRNA. Reggie is 67, Regina is age 65, with $250,000 in savings and taxable brokerage accounts, $1 million in a traditional pre-tax account, let's say a 401k or IRA, and they have 0 existing Roth accounts. So they have a total of $1.25 million saved for retirement. We converted $50,000 a year for 7 years, totaling $350,000. Their annual spending is $96,000 per year, also pulled from these accounts. Their combined Social Security income is $56,000 a year. Their investment rate of return is 7%. That's offset by inflation per year of 2%. Now, for those of you watching this on YouTube, you see a projection of ordinary income each year with and without Roth conversions. And you can see each tax bracket threshold overlaid in the different colors. But the main point to notice is that in the base case, or with no Roth conversions, this couple spends most of their time between the 22% and 24% tax brackets. While with the Roth conversion case, they always stay below the 22% tax bracket. Now, remember earlier, I talked about lifetime projected taxes. Well, the annual taxes this couple will pay with and without the Roth conversion plans. Without Roth conversions, their lifetime tax is $720,384. With the 7-year Roth conversions, total lifetime tax is $334,920. So that is a lifetime tax savings of $385,464. So we've just saved this client $385,000 in taxes. Let's move on. What about their portfolio values? In which scenario would they have more money? Without Roth conversions, this couple would die with $2.88 million. With the 7-year Roth conversions, this couple would die with $3.36 million. That is an increase of $483,464. Now, the reason the Roth case is higher is because of not having the annual tax drag on the distributions for living expenses. So, not only did we save $385,000 in taxes, we also increased their portfolio value by $483,000. That's an $868,000 swing. So those were the hard dollar costs. But remember earlier my statement about pre-tax are terrible accounts for legacy and wealth transition. Let's look at some of the qualitative planning. Without Roth conversions, how would the ending value of $2.8 million be held? Meaning, in what account? Well, this couple would leave $916,000 of their $2.8 million nest egg in the pre-tax 401k or IRA as 100% taxable to their heirs at their tax brackets. At 24%, this would be $219,000 due in federal income tax. Let's do the same thing, but looking at the 7-year Roth conversion plan. In this case, Reggie and Regina leave $3.3 million to their beneficiaries, but only $526,000 is 100% taxable to their heirs at their tax brackets. Again, at 24%, this would be $126,000 due in federal income tax. And so I want your main takeaway to be that this all works, Roth conversions, because you are lowering future required minimum distributions. Lower RMDs equals lower taxes. In this example of, quite frankly, Reggie and Regina CRNA are a middle income couple with $1.25 million saved for retirement. I'm not showing you somebody uber wealthy, but my point is that you can easily save hundreds of thousands of dollars by either converting to Roth or making the bulk of your future retirement savings to Roth while we're in such a low tax bracket environment. The time literally is now. You do not want to wait. Okay, so your takeaways. Traditional pre-tax retirement contribution is a fake deduction because you pay it back. The Secure Act eliminated the stretch provision of deferring tax. Current tax rates are at historical lows. The QBI deduction interaction reduces pre-tax benefits. RMDs for you into the government plan. There is a $37 trillion wealth transfer coming, and Roth provides tax certainty and control. And so your action steps that you can implement immediately: consider stop making traditional pre-tax contributions, maximize Roth contributions on both the 1099 employee and employer sides. Consider Roth conversions, especially during low tax years. Use current tax brackets strategically. Plan for wealth transfer. Convert on behalf of your beneficiaries. And focus on lifetime tax planning, not annual tax savings. So get rid of Uncle Sam while you can. Pay tax while it's on sale. Do Roth conversions. Set up your future tax-free. I want you to keep as much money as you can for the rest of your life and pass it on to your family or whoever your beneficiaries are, all of it tax-free. Everything I've talked about today has worked to this point. More people should consider putting much more of their retirement and legacy money into Roth. It's just that simple. You are paying taxes on your terms, not the IRS's terms. Again, the bottom line is simple. Traditional pre-tax retirement savings made sense before 2020. Today, they're probably the worst asset to own and build on. Tax rates are at historic lows. The Secure Act forces your beneficiaries into higher tax brackets. And if you're a 1099 CRNA, pre-tax contributions reduce your QBI deduction by 20 cents for every dollar you contribute. Focus on what you're keeping, not what you're making. Roth accounts give you control and certainty. No sharing with Uncle Sam. No required minimum distributions, forcing you into the government's plan. If you want to see exactly how this applies to your situation, schedule a meeting with me at oakcapitaladvisor.com. We can talk through whether a Roth conversion makes sense for you and discuss your specific situation. Thanks for listening to Money RX for CRNAs. If this episode helped you see retirement planning differently, please share it with a colleague. Until next time, keep building that financial foundation.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.